All right, guys. Happy Friday. Welcome to the Educated Homebuyer Weekly Edition. This is something Josh and I have started today, and it's going to be every single Friday going forward. It's going to be a recap of the week to help you, set up as a home buyer, as a seller over the weekend. We're going to recap exactly what's happened this week to give you some direction. And one of the biggest things that's come out here in the last 24 hours, Josh, is the Fed has Waller from the Fed has basically come out and said that interest rates could be cut as early as July.
And the reason why this is important, Jeb, we had the Fed meeting. The most important thing that happened with the Juneteenth holiday, we only had 4 business days, not a lot of economic news Monday, not a lot today, but we did have this Fed meeting. The Fed came out as a of what they think will happen over the next 12, 24, 36 months. And they basically stuck to the plot. A few more members said, we don't expect any cuts this year, went from 4 to 7, expecting no cuts. And a few more said anywhere from 1 to 3 cuts. Sure. So that was the big news. Markets digested that yesterday with the Juneteenth holiday, no economic news. So kind of everyone chewing on that. And as you said this morning, CNBC does an interview with Fed Chair Waller, and he's basically saying we're behind it. So a couple of interesting quotes. He said, we can start the process of bringing rates down, and then if there's a big shock, we can pause. We don't want to wait until the job market tanks before we also start cutting the policy rate. He pointed out something, Jeb, that you and I have been talking about here and think is going to be the long-term impact of tariffs, is that tariffs are a one-time level effect, not a driver of long-term inflation. So any tariff inflation, we should look through it in terms of setting policy. He pointed out that college graduates are not finding jobs. Their unemployment rate is 7%. As part of the dot plots, the Fed increased their projection for the end of the year of 4.4% unemployment to 4.5%. Probably going to be a little bit higher than that. The reason why college graduates are canary in the coal mine is those are the new people entering the market. What we're seeing is employers are not hiring. They haven't been doing mass layoffs yet, although we saw a big rise in WARN notices this week, the highest since August of 2023, which indicates that layoffs are coming. But we're not seeing layoffs in mass. But the new people entering the market, even young, educated, qualified people, are having a hard time finding jobs. Does it mean that the jobs market is terrible, that we're going to have 10% unemployment, that the recession or a crash is coming? Absolutely not. But definitely the slowing. And I think he's right here in terms of they probably should get ahead of it. It was probably right to not do anything here at this meeting, but he's saying we should cut 2 more times this year. And most of the experts that we follow are kind of coalescing around that. If we look at the Fed futures market, predicting 2 cuts, so a down 0.5% over the rest of the year. Hopefully that translates into mortgage rates and lower rates and better affordability for those of you in the market and looking at buying. But as we saw with the percent of cuts last year and rates actually increasing, we don't have that guarantee of that.
All right. So with that said, Josh, let's talk about kind of big picture summary this past week. So mortgage rates hovered around 6.93%, which basically for anybody out there, more or less unchanged on the service, might have got an eighth here, higher, lower in some regard, depending on what you're buying and when you actually pulled the trigger there. But beneath the surface, little weaker economic data, as we just discussed, which in turn, that continues. That could lead to lower mortgage rates, could lead to the Fed cutting. I mean, policy is restrictive right now, which is exactly what the Fed wants. And we do know the Fed has a tendency to go too far in either direction, be behind the curve, kind of on both sides of that. And so, at least Waller's coming out, kind of voicing opinion. So that he can kind of point at him and say, "Hey, I told you so." If it doesn't go in his direction.
Well, Jeb, the other big news of the week is President Trump and Treasury Secretary Bessent just all over Powell, saying he's a loser, an idiot, should be cutting.
Pulte too.
And Pulte and should be cutting 2.5%, and that's insanity. So the truth is probably somewhere in the middle.
Sure.
What they did, they want to talk about long and variable lags in the data showing up, yet they're sitting here saying, well, we want to see it show up. And what Waller is saying is, we've seen the canary in the coal mine. We've seen the job market weakening. We should be less restrictive than we are right now. Not accommodative, not going back anywhere near zero rates and that type of stuff. But a couple of the other big pieces of data we got this week, Jeb, retail sales showed some resilience and some slowing. So the core spending was a little bit higher than expected. The headline was lower, was worse, but then the core, the things that are most important to the economy, held up pretty well. Another data point, architectural billings hint at future building recovery. Well, multifamily was showing a decline. So it just could tell you that we're not going to be building as many homes. Global central banks, we had cuts from Sweden and Norway. Does that mean anything here in the US? Not really, other than there's a lot of coordination among central banks around the globe. So we are behind the curve. Central banks throughout Europe are cutting, likely to happen. You already talked about what happened with mortgage rates, slightly better than the week before, but less than 1/8% improvement. So if you're out in the market, you're probably not even noticing or seeing this. So we had some negatives. Initial jobless claims remain elevated at 245. We say that's a negative. It's a negative for the economy. It's a positive for interest rates. As we see unemployment go up, that generally indicates that spending will be down, inflation will be down to 32, the lowest since December of 2022, when we first started seeing that spike in interest rates. And that's not shocking. We know this. Builders' margins have gone from 30% down under 20% now. They're still making money on their houses, but nothing like they were before. Housing starts dropped. Not to be unexpected. They don't want to end up with a glut of supply like they did in 2008. So because of that, they're just not going to build as many homes. They have to build homes because that's the only way they make money, but they don't want to build any more than they have to at this point. Mortgage applications were down a little bit. I know Logan Mojami focuses on this a lot, but especially coming off, we had a holiday week 2 weeks ago. So we had a really hot week last week where the numbers came in high. They came in low this week. If we average them out, I don't know if there's a whole lot of signal there. We like to monitor several newsletters that go through all of the releases and conference calls for major public companies. Both Lennar, a home builder, and Kava, where we all like to eat lunch, came out and they signal consumer hesitation. They're saying builders and retailers are noting a foggy consumer mindset. And that's about right? None of us really know what's going on right now.
Well, on that front, Josh, I mean, as a listing agent, right, you don't see the market like I see the market in many ways, right? Because I'm out there talking to a lot more of the consumers. You talk to them once they've already found a property in many cases, or they're in the process of trying to buy a home. So they're getting the application done. I'm out there with them real market as a listing agent, sometimes hearing buyer activity or seeing buyer activity rather. And what I can tell you is there's hesitation out there in the market. And sellers, agents, there's some unknowns. And I had a conversation with, and I'm like, what's the problem? And she's like, it's just like things aren't moving. And I'm like, yeah, this is a more traditional market. And so I think, again, this isn't a plug to get you to go out and buy a home, but there are opportunities out there now. There are sellers that need to do certain things, whether it's move to another state, whether it's they've already bought something and they need to unload this property or whatever. There are opportunities. And sellers are having to adjust, what they believe is going to happen, their expectations. Patience is key in this market, right? So that doesn't mean waiting is necessarily going to get you a better deal. But what I can tell you is that as more inventory comes to the market, which is likely going to happen over the next couple of weeks, I don't see a big movement happening in rates, Josh. So rates are probably going to stay somewhere in the range that they're in now, an eighth here or there, which means inventory is probably going to grow a little bit. There's going to be a little bit more quote unquote panic out there with certain buyers, but real estate's local. Pay attention to what's happening in your market. There's stability with rates, which is probably this is probably the longest stability piece that we've had in rates in I don't know, months, Josh.
Yeah, we're going back and we looked at it the other day, to the end of March. We've been kind of in this fairly narrow range of about 0.25% in rates. I agree with you. What's likely next is just some continued slight improvement. And we're going to get some reads this week. We get PCE. So the last couple of months, PCE and CPI have been overlooked and not real market movers because there was this feeling that there's a lag for the tariff data to show up. If that tariff information starts coming in, we have some low numbers falling off from last year. And if we get some tariff impact of pushing it higher, you're going to see the year-over-year figures a little bit higher. And on the headline, you're going to see in the headlines, ooh, inflation ticks back up. Well, it hasn't really. Just like Waller was saying, tariffs are causing things to be more expensive
Sure.
in the short run. And when we had a lull in inflation last year and an artificial blip, one-time blip right now, it's going to look bad month over month, most likely. So it will be interesting to see how the market works through that. And for that reason, I think that's why both of us don't really expect a big dip in interest rates, because this uncertainty, we're not going to get clarity probably till the end of Q3. Hopefully heading into the fourth quarter, we have a little bit more clarity for all of you in terms of what happens. But right now, one of the things we want to do with this weekly update, if you're out there, you just put a property under contract, you're looking at homes this weekend, what does it mean? Rates should remain stable. For most people, that still means lock the rate once you have a property under contract, just because there's so much uncertainty and stress around that home buying process. It's one thing. Let's just take that out of the equation. Not even worry about it. I know what my rate is. I know what my payment is. Let me worry about my appraisal, my home inspection, any negotiations going back and forth, and getting conditions to my lender. So in terms of not rate lock float recommendation right now, I don't have any strong belief that rates are going to the moon and we need to lock today. But for most people, it's still the right decision, despite the fact that rates should be stable to moderate decrease over the next month.
And if Josh and the team can be of assistance to you, whether it's pre-approval, whether it's you found the property and now you're ready to just look at rates, use that link scrolling the bottom there. Well, actually, that's the wrong one. It's theeducatedhomebuyer.com/start. And you can get in touch with Josh and the team. And if you're out looking at property, don't have a real estate agent, you can use that same link. And I'm happy to have my team guide you through that process as well. You can definitely do that. But if you're listening right now, finding any value at all, do us a favor, hit the thumbs up. If you haven't subscribed, make sure you do that. This is a new series that we're doing, and it's going to continue going forward. It's going to be a weekly recap, right? We typically do the live Q&A on Wednesdays on my channel, Jeb Smith. But now we're going to be doing a weekly recap, more data-driven, kind of to set you up for what the weekend holds and what you should be expected, whether data being released later today or something coming on Monday, so that you know whether or not you should be locking. So Josh, where are we in the market? It's again, there's uncertainty, there's some stability. Prices in some markets are moving sideways. How should buyers approach what we're headed into here? I mean, you said something to me today. If prices drop 10%, no one would buy, right? It's the panic. It's the expectation that, hey, I'm going to wait for this to happen. And when this happens, that's when I'm going to jump on. And the reality is, we both know from being in the business back in 2008, if shit hits the fan, nobody does anything.
Nobody does anything.
We're going to wait for things to get even worse, and then we're going to do something. And then those people miss the boat entirely.
Here's what I can say. We use an example I've used 1,000 times. The very first home I flipped, we bought in October of 2008. Everyone told us, you're an idiot, you're insane, don't catch a falling knife, market's still going down. We bought a house for $265 that the owner had paid $675 for just a little over 2 years before that. The house was awful, needed a complete renovation. We put $55,000 into it. At that time, allowed us to do a complete renovation, new kitchens, new bath, flooring, doors, molding, anything you touched, including the roof, was brand new in that house. We sold it for $400,000. For $275,000 less than 2 years prior, someone could get a brand new, completely refurbished home. And we had a buyer. There was a buyer. But I'm telling people, whatever social media we had at that time, email people on my list, this is what you're able to do. You could either go get the dog shit house for $275 and fix it yourself, or get a turnkey home for $400,000. Everyone said, you're crazy. This market's still going to drop. It's like, okay, we're still early in this. We sold that in early 2009. So we get to 2010 and we were near the bottom. We kind of bounced there for 2010, 2011, 2012. We didn't see this run up, but all we heard from people is, oh, you're crazy. There's another leg down, shadow inventory. This is going to happen. The economy is still terrible. But what we watched from 2010 to through the end of the pandemic, 12 years of steady increases before a skyrocket in prices. So what we can say is that you may sit here and believe, I want home prices to drop 10% to increase my affordability. The reality is you don't want that. It's not likely to happen, but you don't want it because you won't buy. You just won't. It's easy as a renter, whether you're renting an
apartment. You might not have a job.
At that point, it's easier to say, I'm renting this, and that uncertainty, I want to see how this plays out. So, we'll do a deeper dive, and maybe on the live show next week on your channel, Jeb, we can kind of go through. I think the Austin market is kind of telling. They've been 3 years in a row of down, and cumulative drop in that market kind of is indicative of what happens or what would likely happen in a correcting market versus big 2008 style crash. But from that perspective, I think we are headed for a protracted period of diminished returns. So low returns, 0, 1%, 2% annual rate of return on home price appreciation. So you have this stability. You should be able to see incomes increasing over the next few years for for our buyers, whether they're professionals, trained professionals, plumbers, excavators, cops, school teachers, trained, educated professionals. The people that are buying homes are likely to not be experiencing a big increase in unemployment, and we're not likely to see. We hit 10% during the Great Financial Crisis or the Great Recession in that last financial crisis. We're not likely to see that. The Fed's projecting 4.5. They usually end up, in retrospect, being conservative. Maybe you get 6% unemployment. It's still nothing like what we had seen in the past. So from that perspective, really, just when the time is right for you, do your due diligence, know your market, know your numbers, and know when it's right for you to step in.
And the reality is you're not late right now. You're not missing out. I mean, you're navigating one of the toughest markets that we've seen, Josh. This is taking us back some years, right? I mean, I started selling real estate in a market where homes would sit on the market. I mean, some would sell quickly, but some would sit on the market for a year in some cases. You had to do multiple price reductions. Today's agents haven't been in a market like that, the majority of them. And again, we all have short memories. We all look and go, man, I feel like that home should have sold now. And then you look at the days on the market and you're like, it's 25 days. You're like, I guess, I mean, that's what, just over 3 weeks? Not really a big deal. It's because everything has been so moving so quickly in such a short period of time that we lose that the idea of what normal was. And then, so understand it's a part of it's seasonal, part of it's inventory, part of it's affordability. There's a lot of things going in. It's confusing. Just make sure you have the right team on your side to help guide you through the process. Not somebody that's pushing you to buy a home, but somebody that's able to help you when you're ready and ask you the right questions to make sure you're making the best decision for yourself. And if you need that person, you can reach out using theeducatedhomebuyer.com/start. You can also use that link on the bottom of the screen. Both will get you in touch with Josh and the team, and we can guide you through that process. So Josh, where would you like to leave our first weekly update?
Let's give you a quick look ahead to next week. What data do we get? We get the data that comes out every week. Jobless claims, weekly jobless claims, mortgage applications. We're also getting existing and new home sales next week, and the big PCE report. Still don't know that it's going to be a big market mover, but that's the big one that we want to look at next week. Likely to remain flat, slightly better. We'll check our prediction next week, Jeb. When we show up next Friday, we'll say that we believe that rates were flat to slightly better, and we'll see how they actually move. But again, if you're out, you're looking at homes this weekend, you have questions, you want to get pre-approved, you want a second opinion on some numbers, when we do that, maybe 1 out of 3, we see good numbers. Hey, you're in good hands. Continue down that path. About 65% of the time, we see some crazy stuff that we can help you either get into a better loan or a cheaper loan or both.
All right. So if we can help, make sure you reach out. But until next week, make sure you buy right, borrow smart, and build wealth. Adios.
Amigos.
Oh, and let us know what you thought of the show. If you're here this week, did you like the weekly update? I forgot to ask. Let us know. Adios.